same old life. You got my body, now you want my soul. Don't even think about it, it's so no. 'Cause I'll do anything that you want me to, baby.
Yes. My router is that part. My router is a LTE router. Yeah. The paradise right. So they didn't give me access to everything. They gave me so I've sent it. I just told them like confirm. They didn't give me access to everything. If you really love it, you just can share the link and tell you whether I like it or not. But for now,
what I wanted to see is I saw that they set up recording show to okay, that's just what I wanted to show.
Okay.
Because once you
monitor feedback, you give that question tomorrow.
I do something.
No, live stream. What if there are questions coming in?
Oh, okay.
You have a monitor.
See the live chat and stuff.
Well, you are talking about so you need someone on that end to track it.
Yes. But I'm not sending so what I'm checking.
I know today we go live.
I've started, I've sent it sends to me like a last time. Yeah, it's pretty to go live option.
okay, the way that I see it.
Yes. By the end of the day, you send 60 frames. I know someone that used to have buyers or like Saba Farrow. If you're in America, you know, your frame is clearer than when you're in Nigeria.
He said it's like already. Yeah, that's how it is.
That's the link.
Why Lisa?
Yes. Yeah, yes, okay, no problem. Yeah, definitely. Yeah, it is good. Just wanted to confirm.
I don't know.
Yeah, that's what affects.
Let's say, they were giving us 100 of 100 down. Definitely. What's the output like right now? I'm not saying that I can't explain that it's very clear that people want like or like song service or a paper part and they want to work for the service. I think that is that camera and like the perfect exposure would be one black person to overexposure to the white person. So right. I heard that those guys have done.
I'm using PK's egg.
Quand il te prend dans ses bras, et puis il te parle tout bas, tu vois les signes étoilés, la lune caresse tes yeux.
I call them just on the island.
Le danger est tout près. Tu glisses ces mots d'amour, ces mots dès tous les jours. Tu danses aux Champs-Élysées, t'as les sourires du soleil. Voilà ton cœur volé. No, my friend. Here comes the end. Fall in love, give the best of you. Before the sun rises, you'll be singing the blues. Come on, you face it. Come on, you face it. Come on, you face it. You gotta face it. La vie ne passe en rose. No, 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 no. La vie ne passe en rose. Mais dans ces plus les 50, l'amour n'est plus éternel. Il a fallu se réveiller, il a fallu ouvrir les yeux. C'est pas qu'on disait Jean-Paul, l'enfer c'est pas les autres, non. C'est toi qui tombes dans les pièges, encore une fois que faut c'est elle. La vie ne passe en rose. La vie ne passe en rose. Non, non, non. S'il est entré dans ton cœur, fais gaffe, c'est ça le bonheur. Il va peut-être le frapper, ça portera la douleur. Chagrin sous l'arc-en-ciel. No, my friend. Here comes the end. Fall in love, give the best of you. Before the sun rises, you'll be singing the blues. Come on, you face it. Come on, you face it. Come on, you face it. You gotta face it. Chopala, Chopala, Chopala via rose. 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 Chopala, la vie ne passe en rose. Chopala, Chopala, Chopala via rose. Chopala, Chopala, la vie ne passe en rose. Chopala, Chopala, Chopala via rose.
Is anyone the new age is one? Without like doing it, slapping it like doing what's happening not let's talk about that plot. This also does it. There's one. It's like a honestly, no one. You know, most of the time I don't do it. Sometimes I will drop my that. I've not had that because maybe it doesn't work for them. But I'm just using. It's just that yes. All this year. Can I look that nice? That's the best thing.
On the outskirts of Frisco, I was cruising with my favorite gang. The place was so boring, filled with out-of-towners touring. I knew that it wasn't my thing. I really wasn't caring, but I felt my eyes staring at a guy who stuck out in the crowd. He had the kind of body that would save Adonis and a face that would make any man proud. He's the greatest dancer that I've ever seen. He's the greatest dancer. The champion dance, his moves would put you in a trance, and he never leaves the disco alone. Arrogance, but not conceit. As a man, he's complete. My creme de la creme. Please take me home. He wears the finest clothes, the best designers, heaven knows. Ooh, from his head down to his toes. Houston, Gucci, Fiorucci. He looks like a steal. That man is just a kill. He's the greatest dancer that I've ever seen. He's the greatest He's got something you just can't trust. It's something mysterious. And now it seems I'm falling for him. He seems to have an invisible touch. He reaches in and grabs right over your heart. He seems to have an invisible touch and takes control and slowly tears you apart.
It's my feeling we will win in the end, and I want touch your defenses, vanity and security. But don't you forget about me. Take you apart, I will put us back together. Don't
Over time, I've been building my castle of love, just for two. Though you never knew you were my reason. I've come much too far for you now say that I've got to throw my castle away over dreams I had picked out a perfect and true. Though you never knew it was of you I've been dreaming. The sand that has gone from too far away for you to say come back some other day. And though you don't believe that they do come true. Boy, did my dreams come true reality. And maybe to a few I believe you too might be overjoyed, over all the hearts I have paid for return every stone, just to find I have found what I searched to discover. I've come much too far for me not find the love that I've sought can never dreams I have picked out a perfect and true. Though you never knew it was of you I've been dreaming. The sand that has gone from too far away for you to say come back some other day. And though you don't believe that they do come true. Boy, did my dreams come true reality. And maybe to a few I believe you too might be overjoyed,
Last one is by time. At the end of the day, it's not about money for that. You know, program, something that sleep in mind, that want to like straight. You just come on the side there. But those things are just what's out there. It's like, look, you are too much high.
no ceremony of Buddhism is
Let's go
like
and get
you.
it. Yeah, I don't mind. I see. If I see where other clothes. Yeah.
No sé camino por estos lares. No sé caminar por esos lares. Eu não consigo te escutar, eu não consigo. Eu não consigo te escutar, eu não consigo. Oh, me voltou. 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 Oh, me
Yes, I'm
If you get to adore yourself, do you think it's okay? Ain't gonna answer well. And if you get to show the world how amazing you can be, how amazing you can be, why? Do you believe that little lie? We're gonna need another kind of love, yeah. We're gonna
Hello, hello. Okay, excellent. My name is Sam Emmanuel, and I've got the pleasure of welcoming each and every one of you. It's slightly past 6 p.m. We're meant to start on the dot of 6 p.m., but we're waiting for a few people to join us. So please bear with us, but carry on with networking, getting to know someone beside you, and in the next few minutes, let me not tell a lie. In the next maybe 15 minutes, we will start. Yes? Thank you very much. Oh, one more thing. If you've got, do we know what type of car it is? Toyota Corolla, EKY 721. Is that HK? Yeah, if you are the owner of that car, please, they need you to move it. It's blocking somebody. I was going to say something else, but thank you. Oh yes, and then we saw each other at your wedding again. Exactly. Ola Brown.
Yeah, I would be there, but I'm sorry, I'm writing this person sings so well. I'm actually writing this one for you. You should be thankful.
Okay, here's the part.
Keep
Is that possible? Payable when able. I understand. Which one? Did I not say? Did I not say? Did I not tell you I owe? Then don't worry, I'll pay you later. What are you waiting for? What does that mean? Do you know? How far away? How far away? Oh, she didn't tell us that.
Then she shall smile. That was just this is fun. Like very food. Very soothing accept. Have you been drinks or
Amor en Milano. Amor en Milano. Amor en Milano.
Hello, hello, hello. Hello, hello, hello. You know you're the moderator, right? Hello, 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 hello. Welcome, everybody.
It has a room by the side.
Good evening once again. Welcome. Good evening. My name is Sam Emmanuel, and I am the stand-in for Tommy Davis, who very big shoes, huge shoes. I'm for those that don't know, I'm the chief errand boy at Semicolon. Semicolon, we are essentially focused on workforce development to essentially provide all the wonderful people that would power a lot of the startups that will be part of the conversation today. Without further ado, I'm going to welcome Yemi Kerry to give us the opening remarks.
Good. Yes. Good evening, ladies and gentlemen, and thank you for making time out to come this evening to join us in the celebration of our 10th year anniversary of AESIS. I run an angel network, a female angel network called Rising Tide Africa. But for the purposes of today, I would be speaking on behalf of African Business Angel Network, who the ACES as a board member of African Business Angel Network. I want to share with you, the journey so far, how it all started, and how we find ourselves here today. The Africa Early Stage Investment Summit, which is what we are celebrating the 10th year of, it can be traced back to the Africa Angel Investment Summit, which was held in Nairobi in 2013 and 2014. We created that in recognition of the need that we needed a platform to connect early stage startups and angel investors and other sources of funding. The first ACES event, which held in 2019, brought together almost 100 angel investors, entrepreneurs, and ecosystem players across the continent. And therefore, following the success of that event, we decided to host a second ACES in Nairobi in 2014, which attracted even more attendees. Then it started to buzz on. In 2015 and 2016, we moved ACES to Lagos. To Lagos here, where it continued to grow in size and scope. The Lagos event featured a range of programming aimed to supporting the growth and development of the ecosystem. The following year, in 2017, the event branded as Africa Early Stage Investment Summit and moved to Cape Town. During the years of 2015, 16, and 17, thank you. Is this better? Yeah, it's clearer. During the years of 15, 16, and 17, a lot of things we're doing was learning on the journey and also documenting the journey. You would see a lot of us in the programs, the African Angel Academy. Those were earlier broader vision of promoting early stage investment throughout Africa and the need to include the early stage venture capital partners operating on the continent. We originally set out to create a platform to connect African startups and local and international investors. We recognized that there was a lack of structured networking events and opportunities for startups and early stage investors to connect on the continent, and saw the need for more education, capacity building for early stage investors on the continent of Africa. Yay. Error. They can't. Since inception, objectives have evolved to meet the changing needs of the African startup ecosystem. Some ways in which these objectives has evolved are broadening our focus. While AESIS initially focused primarily on connecting investors, the event has since broadened focus to include other ecosystem players, some of whom are here today. The VCs, we have then also the accelerators, the incubators. We have people from the government here, the other funding agencies like the board of, is it hot or is it me? Okay, it's not me. We are broadening the focus and the value in which AESIS is operating. We have started incorporating a lot of capacity building. We are expanding across geographies. I was saying that in the last year, 2021, we had AESIS in 30 cities simultaneously around the continent of Africa. And by tomorrow, we'll be counting, so it's today and tomorrow. So there are a lot of meetups going on. And by tomorrow, we'll be counting how many cities are hosting AESIS. There is the emphasis on social impact. It's increasing emphasis on the importance of social impact as a key consideration for startups and investors operating in Africa. We know that now, if you follow the money, you might make money. If you follow the problem solving and the solution provision, you will definitely have a value proposition and you will make money. So that is the real, but now everybody's talking about ESGs and sustainability and things like that. And we're encouraging startups to incorporate them in their value proposition. With that said, welcome remarks done. Thank you.
Thank you very much. Thank you. Thank you very much. At this stage, I'd like to invite Caspar, one of the supporters of the event this evening, for a few remarks. Thank you.
Thank you, Sam. Yes, good evening, everyone. Thank you very much for having me. I'm working for the GIZ for a program called ZEISS. It stands for Scaling Agriculture Innovations Through Startups. And we're very happy to support again this gathering because I think it's the crucial part for success. And maybe to give more background what we're doing, we believe that this 10 times exits are also possible in agriculture. And with this nice exits, there's not just coming money in, but also impact, because in agriculture, it's going hand in hand. It's almost automatically. So I'm very happy to meet you here, have some chats later on to describe more what we're doing. We have a startup accelerator program for Francophone Africa, for English-speaking companies, and for livestock tech startups. So we're even diving deep in specific topics, because we believe that in livestock, there's even more money and impact to be generated. And that's why it's funded by the Bill and Melinda Gates Foundation, that program, to build startups in that sector. I encourage every investor to look in the portfolio. If you have a climate tech, food tech, ag tech startup, to apply for our program. It's totally free. It's tailor-made to help them to grow from seed to Series A, mostly. In agriculture, that journey is long, and they start wherever, so we are there very flexible. And we have a call for application open, but we also can take them any time in the year. And of course, we are doing this for a couple of years now, so we have a strong portfolio of companies. So if you would like to invest in agriculture startups, I encourage you to look at our portfolio. I would love to share them, make introductions, and we have an investment readiness program, so we hope they are investment ready. That's our promise. But we would love to have the feedback, and also the startups need the feedback. Also, if you decline, they want to grow. So if you have the time, look at the portfolio, get in touch with them, and help them succeed. And yes, I'm very happy for this evening. I'm looking forward, and hope we have all a great time. Thank you for having me.
Thank you very much, Caspar. Thank you. When he first told me about the livestock program, I was like, that's rather specific. But of course, during the course of the conversation, we agreed on the, on the fact that, yes, it made sense to be that specific. We'll hear next from another supporter representing LAN, Lagos Angel Network, Biola Alabi.
Good evening and welcome everyone. This is our home turf, and Yemi is part of Lagos Angel Network, even though tonight she's representing the African Business Angels. Just a little bit about Lagos Angel Network, for those of you that don't know us. We have been around for over 10 years, and we have been investing in startups since then. So our main objectives is to invest in startups, for our angels to roll up their sleeves and mentor and also help those startups. We're an angel network for a reason. It's not just about writing a check and sitting back. For us, it's about leaning in and actually going on that journey so that these 10x exits are a reality for our angels. I see some of our angels here tonight. Another thing for us is really about advocating for the ecosystem. We have quite a number of people on our board, in our community, that are very passionate about our ecosystem, and so that's really one of the things we do. So if you have a problem, contact us. We will see how we can help you or direct you in the right direction. Membership is important. Membership and community building is also really important. So it's never too early to start angel investing. So please join us on this journey. Learning and education is also another big pillar of ours. We believe that the more angels we have in this economy, the more jobs we can create. We know that this is the essential and only way to lift people out of poverty, and each and every one of us here has the ability to invest and to create. And so we're here to help you on that journey. If you have any questions, a few of our board members are here. I will also be here. We look forward to having everyone as part of the community. Once again, thank you for being here, and thank you for supporting our ecosystem.
Thank you very much. Thank you. Thank you very much. And there's a highlight of the evening, which is the panel discussion. There are a number of founders in the room. Tonight's event is really bringing together a number of players within the ecosystem. But I think very importantly for the founders, we get an opportunity to hear how the investors talk about exits and why they're pushing us for growth, that the essence of the investment is that they make some very good returns. So with that, I'm going to invite Dr. Ola Brown to the stage. She'll be leading a conversation, a panel conversation, where are the 10x exits.
Okay, all right, perfect. Oh, this is fine.
Joining Dr. Ola Brown, Olumide Soyombo, and Aboyeji.
Good evening, everyone. My name is Dr. Ola Brown. I'm the GP at HealthCap. HealthCap is an investment company that invests in healthcare and fintech across the 4 major African markets of Nigeria, Kenya, South Africa, and Egypt. We currently have 25 portfolio companies in those 2 sectors. Together, they create 1,000 jobs and serve nearly 1 million customers. We're not a gender lens fund, but I think they say that female fund managers are about 30% more likely to invest in female founders. So 50% of our founders are actually female, and 50% of the executives that work in our companies are also female. So it's great to be with you today discussing the question that every single investor asks us when we're raising money from them, unless you're unbelievably liquid like Mr. Olumide. But if you have to raise external funds, then every investor is asking about exits. Where is the liquidity going to come from? And particularly now that the market has slightly changed, as all the founders will know in the room, and people that are raising venture capital funds also know that as well. The other asset classes have become a lot more attractive. The fixed income rates have risen to historic, like for the past 10 years, I've not seen fixed income returns so high, making private credit and fixed income like treasury bills and treasury assets a lot more attractive. And obviously decreasing, hitting us in 2 ways. Number one, hitting us in terms of the valuation of tech stocks on the New York Stock Exchange at least, and also hitting us in terms of LPs, the people that fund venture capital funds to fund you, also sort of diversifying away from private equity in general, venture capital and private equity, and putting more of their money in like real estate and fixed income. So normally when I start moderating a panel, I ask the panelists to introduce themselves. But I think there's no need for that. It will be a bit of a wasted exercise. These are 2 of the most prolific investors in the Nigerian ecosystem, and I'm sure you know them very well already, Iyi and Olumide. So they need no introduction, I'm sure, to anybody in this room. Yes. Okay, board members of LAM, as well as everything else that they do, that you all know very well. So I'm just going to move on to the questions. My first question about exits is, when you are looking at a founder at pre-seed or seed, when you know that an exit is probably at least 5 to 10 years down the line, what do you look for when you're speaking to them, and what makes you think she's going to build a company that's going to exit?
Okay, thank you, Dr. Ola. I have this saying that in terms of investing and looking at those founders is we are just rolling dice. Now God, they bring exit. Because we are trying. But really, I think for me, it all comes back to backing the founder first. And it talks about, we can look at so many folks have invested in, I don't know, a couple of them are even in the room, are surprised when we're going through the investment process, and I say keep the deck away. right? Keep the deck away, keep the business plan away, because everything there is not going to happen. So why are we looking at and discussing things that are not going to happen? The greatest work of fiction are in those decks and Excel sheets. So for me, it comes back to the founder and backing that founder. Why should I take a bet on this founder? What risk has this founder taken on themselves? And for me, it's also looking at setting companies that need to be built. If we look at other markets, you can start drawing some parallels on certain companies that need to be built here with certain nuances. And when you find those companies and you find the right founder to build those companies, that tends to be the situations where we find the exits. If we look back at some of the companies either we've done a secondary in or we've done a full exit on, you'll find out that it's been those same super founders that are building in large markets and have the right timing that end up building those kind of companies that give the exits.
Well, I think in our own case, when we're looking at those founders, we're not really thinking about exits. Because, you know, my own firm belief is that companies are bought, they're not sold. So it's very difficult for you to determine the point of exit. But what you can do at that very early time is try and figure out which founders are going to actually create real value, because nobody buys paper. So at the end of the day, when we're talking to those founders, we're actually from day one starting to have a conversation about, you know, who are complementary, you know, legacy players in your industry. And we try to build relationships with those people. Not necessarily because of exits, but just so that at the very least you have a strong channel partnership. And you can leverage a lot of what has been built over several decades before you as you build your business. Thankfully, sometimes that translates to exit, an exit opportunity, but oftentimes doesn't start out as that kind of conversation. The other thing we like to think a lot about is compounded growth. So for us, we invest, typically we're the first institutional investor in the companies we invest in, and we're writing the very first check before most other people. And typically we're investing in a thesis that most people on Twitter would disagree with me about. That's usually my litmus test. So we're typically going off on a limb. But when we start to see that the founder is building a business that is compounding extremely fast, we start to pay a lot of attention, because it means that it's possible our options for exit now increase. So rather than even just selling to a company, we start to think about selling to you know, a growth investor. We start to think about selling to a VC that wants to get in at a blended price. And we start to have those conversations very early. So one of my favorite customers is Barrett Capital. So I usually call Eric and Daladi and say, hey, I have this company, you're gonna buy it in 9 months. You know, let's start, you know, tell me what you want to see and all that. And I think there are a bunch of other people that I usually have similar conversations with. The third and this final point that we look at is we really try to build for exit, right? So what does that mean for us? It means that we don't play around with very complicated structures. You know, I see some companies setting up in BVI or Cayman Island. It's very amazing from a tax you know, perspective, but it makes life very difficult for you when you want to exit. So we like, you know, very traditional structures. You got your Delaware C Corp, you know, that feeds directly into a Nigeria limited company. So we know exactly what we're dealing with, and we're not dealing with a mountain of diligence and tax structuring when it's time for us to exit. So those are just the three things we think about.
Okay, and that leads neatly onto my next question, actually. And I'm sure a lot of the founders in the room are wondering this. So before we get to more specific VC-specific things, I wanted to ask Olumide, what advice would you really give founders who are building for exit? And how is it different from building sort of a more traditional company where perhaps they're building to just distribute dividends or they're building to, give the company to their children's children?
Good question. And I think we are in African Early Angel Summit, right? And we're talking about getting 10x exit. But not every company is built for that. And not every company has to do that. Some of our parents built companies to send us to school, right? And it's okay for the company to die after that. It has sent us to school and we are good. So the tendency to think that I'm building this company and this company is built and we must exit is not necessarily correct. But I mean, in this room, that's why we're here. Because I don't want to invest in the founder and say the founder will now say that after all you said it was to send my children to school fees. That's not why we invested. However, that said, you find that selling companies, and I think Ian touched on it a bit, is you're first building, right, to create value. You need to have something of value before anyone can buy it, right? So it's the first things first is creating value. But in creating value, and I had this conversation interestingly with another founder yesterday, was certain things have to be done right. If you're trying to raise money and you're trying to build a company that could someday exit, first the cap table and the cap structure of that company has to fit a venture backable business. I've seen cap tables before where an uncle has taken 45% of the business, right? And then the guy wants to raise venture funding. Obviously, the founder is already squeezed out, right? And not motivated to build anymore. Not likely you're going to get further on funding, and obviously not likely going to get an exit. But if you built a company wherein, okay, your uncle or your friend and family have given you a first line of funding, and you want to build the business to share dividends or share profit share, those kind of structures would work. So the first things first would be the cap table and getting the cap table right. The second thing then becomes corporate governance procedures and record keeping procedures and so on. You find some very, very interesting companies that you see on Twitter, but then you open the hood and it's a real mess, right? And it compounds, right? The same way growth compounds, the mess also compounds. And getting to exits and or getting further on funding then becomes more complicated because you've not done the right things and so on. So off the top of my head, cap table structure, obviously how you structure that would be different. Governance becomes even very, very important, even for you building the business, not necessarily for an exit, but even becomes more important when you're thinking about exit.
Yeah, I reckon with a lot of what Otumbasho said. The things I would add, I think first of all, it begins with the storytelling and the brand. Because ultimately, 95% of what your startup is doing, or 95% of startups, particularly in our climes, they're not particularly differentiated by what they actually do, right? They're mostly going to be differentiated by the brand, by their ability to build goodwill around what they are. So if you're just building a lifestyle business, then sure, you can feel free to, build a company that doesn't have a very clear story or brand. But if you want to build something that you can sell, then you have to think about the value of the brand, because that's ultimately the difference between a company deciding to go off on their own and build what you have versus buying what you have. The second thing I think that you have to be thinking very carefully about is, and testing very regularly, is whether that business can run without you. The old joke goes that when you sell your company, the first person you fire is yourself. So most companies don't believe you when you say, oh, don't worry, I'll show up with the business. They know you're going to leave in the next 9 to 12 months. So the question is like, they're always looking, does this business, have any legs without the principal there? So if you run a one-man shop and you haven't built a strong team and strong operations and institutionalized the knowledge in your firm, then it's very difficult for you to sell anything other than yourself. And if you're the entire value of the company, then it's just a lot easier for them to just, basically buy you rather than buy the company. So that's something else to think a lot about. And then I'll say the third thing is really starting to think about synergies very, very early. I think a lot of people oftentimes leave things to, they do one of two things, which is careless. One is either they lock themselves into long-term agreements with one particular supplier or vendor who may or may not be in a position to buy them, and they haven't built their company to be an open architecture, open channel company. So, things like exclusives, I like to be very extremely careful about. Things like having strategics on your board. My preference is typically to have both or none at all. That's what we did at Flutterwave. Things like having a bank on your board or on your cap table, usually bad ideas because obviously it's going to be a very difficult conversation for you to have with another bank, to buy. So really trying to maintain an open architecture structure where you can plug and play partners depending on who shows interest in buying, and you can work with more than one. But those are just a few of the very tactical things to think about if you're trying to build a business that you will ultimately exit, because everybody must ultimately exit. Or if you're building a business that's a lifestyle business that's supposed to pay for your school fees. All of them pay for school fees, but one is explicitly for paying for school fees, I guess. Yeah.
Okay, great. And I think whilst you were speaking, I reflected on the Nigerian banking industry, because even though they all do exactly the same thing, they all have markedly different brands, right? If you think Zenith, you're thinking something very conservative. They mainly deal with corporates. They don't even really like retail customers. When you think about GTB, it's the other way, right? It's really, really retail focused and, not so much on the corporates. And then when you think of a bank like First Bank, they have their own very distinct brand, and people like First Bank for different reasons. Maybe your parents, so not many young people they haven't branded themselves in a Gen Z way. And then when you think about some of the new banks coming up, the fintech-oriented digital banks, they're super cool, right? They have cooler advertising. When you think about Sterling Bank, people think more development and all of these things. When you think about Fidelity Bank, then it's more like trade, right? Trade, finance, and sort of that kind of thing. So even though they essentially all do the same thing, they've managed to differentiate themselves in quite a unique way. So that was just what I was reflecting on when you're speaking about brands. And even though people are doing the same thing, they have very different ways of expressing that same thing. When they meet a bankers committee, they all admit to themselves that more or less they're in the same business. So my next question is about South Africa. Over 50% of the exits that have occurred in this ecosystem have happened in one country. Is there anything unique about that country? And what can the rest learn from them? Because there are 54 countries in Africa. How come one place is taking most of the exits?
I told you before, now God, they bring exit. I guess he's focusing on South Africa more these days. We'll come here soon. I think it's a timing thing, right? In different markets, he's looking at different industries and one at a time. But I think it's a timing thing, and the state of the economy, right? You talk about us rebasing our economy to being the largest largest economy in Africa, but it's all about looking at different mirrors, right? Why are we really that? When you look at it in detail. So I think for me, it's the maturity of the market, and that's really what it's all about. Sometimes we tend to forget that some of even land itself is 10 years old, right? We tend to forget some of the early, that is still day zero, even though we've made some early progress, right? If it was a 10-year fund we started in 2013, the first end of life would just be ending now. So meanwhile, in the South African market, you've had almost 3-4 cycles. You've had the early NASPers and so on and so forth. And some early success obviously helped. I think we are due another Paystack story. We are due another Flutterwave story. And that would help the exits, right? It's really about, I remember when we exited Paystack, the first thing I started getting from high net worth individuals was, hey, Olumide, next time you're investing, I have my 50K, I have my 20K, don't leave me behind. There was a lot of FOMO. These were people that would have given their money to invested in real estate or invested in another asset class. So venture as an asset class becomes more interesting as exits start to happen. Those same people today, if you meet them now in this downtown, they're like, it changes, right? The conversation changes. But let's see another exit tomorrow, and then all of a sudden, those same people will be like, okay, I have some money to give. So it's all about chasing exits, and that's the truth. And exits begets exits, right? Success begets success. Once we have more of those, it then comes in droves. That's my take, and at least that's what I'm hoping on.
No, I have a slightly different view from Olumide about God, they make exits. Actually, exits are engineered. That's just the honest truth. And I think that we are not yet at the level of cultural maturity where we understand the value of intellectual property and shared value. And I think that's the biggest problem. I mean, having had somewhat of a front row seat to a lot of what happens, it's usually a conversation between colleagues. And they say, look, I'm doing this, you're doing this, instead of both of us kind of just running parallel to each other, why don't we just have a conversation about strategic options so that we can both, engage, and that's how the exits happen, right? It's usually a conversation. Exits is human beings that put together the exits, and God blesses it. That's what happens. But it is human beings, and I think we don't have enough of those conversations in the ecosystem. And a lot of the reason for that is cultural, if we're being completely honest, right? Everybody believes they can build it, and they would rather spend money trying to own, 100% of nothing than actually collaborate. I use our own selves as an example. I mean, many people don't know this, but Andela really started sort of as a quote unquote an exit of Fora investors from Fora to what became Andela. And the way it started, obviously, we were running Fora, and we realized that what he was trying to do aligned with our vision, of what we're doing. We formulated the vision together. We test ran the vision together, finding the first few things. We became co-founders of a new business, and then we got our investors to take shares in the other company. And ultimately, I think everybody who did that ended up making out quite well on the end results, right? And that's what should happen. But I was very surprised when during the wave of companies, banks starting to become fintechs, every bank wanted to set up a fresh department, and I was like, this is very non-strategic way to do something that should be very important for your firm. If somebody has been running a fintech for 2, 3, 4 years, surely they know one or two things you don't know, and there has to be some respect. And even in the conversation about our competitors, there isn't a lot of respect in that conversation. And, you know, one of the good things I think about our relationship with Paystack was we had a lot of respect for what each other had built. And so that makes a conversation about strategic options a lot easier than when you just think your competition is just foolish and they're just wasting money. So you can't have a rational conversation about value and where each person is actually good. I'm hoping that the winter changes that. We're starting to change our attitude. Rise and Shaka is a transaction that is sort of landmark in this respect. And I'm hoping that there are more companies that follow it. I've tried in the past to get companies to come together instead of die. And it's been very difficult, right? Founders believe that they want to be able to go it alone until the very last dying minutes when there's no value left in the company, as opposed to reading the tea leaves much earlier and then making the decision to make 1 + 1 = 3. So I think it's a lesson. I think South Africa has learned that lesson. Their VCs have learned to be more collaborative. And I think for us here, the VCs and the founders sort of have to, I mean, for example, I don't understand why you have an Okra and a Mono, and there's a stage that's funded $45 million. You're not going to beat them, except you guys come together, or both of you are going to die. So if people are not going to have those type of conversations and be frank with each other, then, you know, you're not going to get those types of outcomes.
You almost veered into my next question, but not quite. And I think, you know, in the banking industry, for instance, I mean, that has been sort of a hub of mergers and acquisitions in Nigeria, and you can see the amount of value that has been created there. I mean, in that Polaris Bank alone, I think there are like 7 banks inside. I can't even, I'm trying to now get the sort of original data to try and find out how many banks are in each bank. And there's so many banks that are in each bank that were in banks before that it's so difficult to actually, Access Bank alone has probably acquired, 20 banks? Yeah. And pension funds on its own. But there was something inside Access before Access was even acquired. So to even start sort of picking apart who is actually really difficult. And in the tech industry, I hope that we start embracing that. HealthCap is actually releasing a report on mergers and acquisitions in the African tech ecosystem. And we know that sort of South Africa has a very active M&A culture. And, you know, it's something that at least one industry in Nigeria has shown it's unfathomably possible. Nobody even remembers that Bond Bank is actually inside that Polaris Bank anymore. We've forgotten about the banks that were inside the banks before the banks, because there are just too many banks inside banks. I don't think people remember that ETB is inside Sterling, because it's been a long time that that merger happened, and there's just so many things inside. So we can learn from that, I think. And my next question is actually speaking to that, which is around mergers and acquisitions. So in the US tech ecosystem and in the European ecosystem, 80% of all exits occur by acquisition. So a company buys another company, and then the remaining 20% happen via IPO. So you see companies listed on the American Stock Exchange that are tech companies. In fact, tech companies make up almost 50% of the capitalization of the American Stock Exchange. So I can remember when somebody in my office was asking, why is Silicon Valley Bank too big to fail? It's like the 20th largest bank in America. I said, no, that is a bank that carries the tech industry. And venture capital, it's only 0.1% of US GDP, but it's 11% of jobs created by venture capital-backed companies. And most of the new IPOs have been created by venture-backed companies. And most of the stock capitalization of their stock exchange is by venture-backed companies. So if they let all those seed companies and pre-seed, pre-series A companies go down, then they're actually losing a pipeline that is driving the US economy. So my question is, do you think we'll see that? And actually, there's a nuance to this 80-20 rule, because in life sciences, actually it's the opposite way around. A lot of healthcare companies or health tech companies actually go into IPO because they're blockbusters, right? They're releasing new drugs, they're curing cancer, they're like Moderna, finding a new type of way to give out vaccines and things. So they're always doing something pretty extraordinary. So they IPO a lot. But in the regular sort of software space, 80% of acquired, and then 20% go on to IPO. And then also within the US, obviously, most are domestic acquisitions, like the great majority are domestic acquisitions, very few Chinese companies or European companies going into the US to buy companies. So I'm going to ask Olumide the first question. Do you think we'll still have that? Do you think 20% of our companies will be able to list either in Nigeria? And we do have listed, I mean, this is the compound of a listed tech company. Chams is a listed company. They've been doing very well on the Nigerian Stock Exchange. CWC, for instance, Computer Warehouse Group, has also listed on the Nigerian Stock Exchange. So do we think that we'll follow that 80-20 rule of seeing 20% listed either here or like Jumia and like Helios Towers listing on the New York? So either listing here or listing abroad. So what do you think the ratio will be? And then number 2, is Tony Elumelu going to buy a startup that is making $1 million for $30 billion or $50 million? Is that ever going to happen? Are our local investors going to start making local acquisitions, or is it going to be the more type of pay stack situation, or the situation we saw in Tunisia, where international acquirers are always the main acquirers in the ecosystem? So IPO versus acquisition, and then local acquisition versus international acquisition.
Okay, I think I'll take the last one first. You see, to do venture in Nigeria or to do venture in Africa, you have to forget Nigeria, right? You have to forget everything about Nigeria or everything about Africa to do venture. And those folks like Tony you mentioned cannot forget everything about Nigeria because of what Nigeria has shown them. So if Nigeria has not shown you anything, it's easy to forget. It's easy to forget certain things. So if Africa has not shown you, but that's really, if you think about those same reasons, right, and protecting the downside, you're never going to do venture. I can tell you for a fact that many of the companies that you've seen exit today were even looked at by some of the banks in the first place. And they're like, nah, me buy this company for that amount, for what I know in Nigeria, for something that one regulator can turn off tomorrow. But then, if you look at if they had done those deals, then let's take for example, if one of those banks had bought Money Point Paystack for 200 million, what value would have they created for investors today? A whole lot. So I think you need to forget about many of the things that are wrong, and stop protecting the downside and optimize for the upside before you can do venture. And that's really when we can then see some of the local players playing that game. But one of the reasons why you would find the big local players not playing that game well, and I can understand also, is I think we got carried away in the last couple of years with the amount of capital that was chasing companies. Wherein I think I saw the main one exit about 300 million or something. And some people on Twitter were saying that I was small. I'm like, where are you people? Where are you people from? That how can they main one exit for just $300 million? I said, this is what sensationalism has done.
You know what I asked? That can Bill Gates, the richest man in the world, can he dash somebody?
He won't. He won't. So we've gotten to that point where, because people figured there was a lot of capital, people figured this is how it should be. I was speaking to a global VC, and he talked about some of the companies at the height of capital influx into many companies. Like African companies were raising at the same val post YC as any other company in even more mature markets. And they were even pricing that even further on at Series A at the same value. And they are both in different markets. How is that happening? I think if we are taking, and I guess it's all in the haste of chasing unicorns, right? But if we are taking a different approach to say, Future Africa, Voltron, Early Angels, we invest in a company at 2 million cap or 3 million cap. If I exit that company at 15 or 20 million cap, I'm fine, right? I'm very, very okay. But you're finding that because that 2 million cap, they start at 15. Where are we going to exit at 75? Do you know how difficult it is to build a company that is worth $75 million, even in the first place? So we got carried away with that, and that mind reset needs to happen in terms of expectations. I was speaking to a founder yesterday that raised that 2 million. He has pushed a bit, but he has not gotten anywhere. And he says, I want to raise at 7 million. I'm saying, you can't raise at 7 million now. How do you want to do it? He said, but I raised at 2 million. I said, what have you done between then and then? If you raise at 3 million, that's okay too, right? You're optimizing for the upside eventually. And until we can start getting and rebasing some of that mindset before we can start saying some of these measures tend to happen. Ngozi is in the room. I know he's one of the big advocates of and tries to make it happen, right? And Ian spoke about the ego sometimes that get in the way, that I know who will be CEO, is it me or is it you? Some of those things affect why companies can, why some of these things don't happen. But I think it needs to be deliberate. There needs to, and I think you will start seeing that happen, right? Because we are saying what many of the venture funds that were raised 4 years ago, 5 years ago, as we start approaching year 7, year 8, everybody will start saying, okay, what's happening now? I guess you then see more of those kind of things starting to happen.
I have similar sentiments. I mean, Future Africa has somewhat of an undeserved reputation for being cheap. But that's because we live in the markets and we know Nigeria, so we don't need to overlook we don't need to overlook Nigeria. So we just try to come in early, and when founders have graduated and gotten above our pay grade, we're very shameless about saying so and letting them go off on their merry way. But I honestly think the future of exits in this market is the stock market, more so than the private market. And the reason for that is threefold. The first thing is, one of the biggest challenges that we've had, especially in the last 2 years, is corporate governance and transparency, particularly in the private markets. And the reality is that it's going to be very difficult to fix that specifically, right? Because many of the big challenges have actually really eaten deep from a reputational perspective. And I worry that global investors may not necessarily be prioritizing this market amidst all the different shifts that they are facing. And as such, we would have to, for the first time, rely on local capital. And the good thing is local capital feels the industry has been validated, and they're excited to come on board. We had a conversation in New York with quite a number of the players, and it's sad that we had to have it in New York, but it was a conversation that was had nonetheless. And you could see the enthusiasm in the room from people like Bolaji Balogun, Ike Chioke, to actually bring some of our companies to market. And the bar is very low. It's not even that bad. If you're doing, $2-3 million in revenue and you have a clear sight to profitability, there's actually a path to the market on the technology board. And the stock exchange is excited to support and bring that to the market. So I don't know how many of us have managed to read VFD's notes as well, but it wasn't like they were extremely huge or something, right? They're doing pretty good, and they're listing. So I think actually we'll probably have a more like life sciences here, because I don't think we have a private market that can accommodate that kind of growth. And at the same time, you've got quite a bit of capital that will face a lot of inflationary pressure over the next 3 to 4 years, as the dollar continues to rise and as inflation continues to rise. And they'll be looking for value from productive ventures, many of which should be technology-driven companies. So I actually think that will happen. And then I think the third thing for me is just, I think I'm starting to see more interesting analysts come to the market. People that are actually very perceptive about how to value the companies, how to look at the companies. There's actually a pretty good analyst group now of people who sort of understand technology, economics, and finance. And I think with a little bit of further growth in that pool, you actually will start to have lots of people who can analyze technology companies appropriately. and help guide the markets on how to look at them. So I'm actually very bullish to see more companies on the stock exchange. Finally, I just in terms of the bank stuff, I think one of the challenges I have, and really it's a challenge to founders, is that I think a lot of what has driven the destruction of value in our ecosystem is a lot of founders lack respect for capital. And that's why a founder will watch a company dwindle even when they could take strategic options and let the company survive. And I think that's an attitude that needs to change. Otherwise, the ecosystem will simply not grow. Founders need to have respect for capital. They need to recognize that people are putting, their lives, sweat into their companies. And even though they may not have had the outcome that they desired originally, they need to respect that capital and make sure that it has the best options. In other markets, you would see founders actually, when they see things are going very south, reach out to you and say, look, can we return the balance of the money? And I think that's really the honorable path. And the founders that have done that or have pursued strategic options early are the founders that I want to continue to deal with. And the founders that have allowed things to go to zero and then show up with another startup tomorrow, I hope the markets will actually discipline them because that's crappy behavior and it's unacceptable.
Yeah, and I think at the end of the day, we're finishing where we began, which is the first thing we started saying is around founders. And I think, the biggest job of a VC is to be able to differentiate between the people that want to be called founders and want to have the title founder and the people that actually want to build a business. Because building a business is really difficult anywhere in the world, but particularly in Nigeria. It's a slog. And sometimes when I speak to founders and I don't really mind where you live, but when I speak to founders, I say that there's a reason that Aliko with all his money still lives in this VI. It's not because he doesn't like nice environment too. It's because there's a Nigerian expression, right, that we use for everything. It's on, it was until I moved to Nigeria 10 years ago that I heard this expression for the first time. It's on ground. Are you on ground? Is the plane on ground? And the master of them all, is there cash on ground? And I think it speaks to sort of just being available, just being able to hit the streets, just being able to see the next customer, being able to go with your sales team and bring that entrepreneurial energy to the people that you're selling to, whether you're a B2C business or a B2B business, and trying to hire someone into an early stage company to bring the energy is really difficult. I mean, like I've seen up until maybe 4 or 5 years ago, I've seen Herbert Wigwe opening accounts for people and saying, don't worry, I'll be your reference. I know you. There's an entrepreneurial energy that comes from even a big man sitting here and saying, please open an account, bring your money. Is it 500,000? Is it 200,000? Bring it. It's still my company. And I see that respect for capital has kind of dwindled, but I think the discipline is coming back now because I think under a zero interest rate environment, you have a lot of unserious people, both unserious investors and unserious founders. But in this time, I'm seeing seriousness back in the ecosystem because the money is not so easy to get. So it's not an easy option to become a founder. And now in a higher interest rate environment, luckily, the serious investors are still here. The tourist investors have gone. And the serious founders are also, growing their companies. They're on ground. They're seeing customers. They're speaking to their customers. They're building their businesses. So I think, it's a good time for serious people to be in the market. Serious investors, serious founders. We meet each other. We like each other. And we sort of grow with each other. The second thing I heard was around former unicorns. And the only way that you can be a unicorn in one interest rate environment and not be a unicorn in another interest rate environment was probably because you were not a real unicorn in that interest rate environment in the first place, right? So the idea of, chasing unicorns in a certain market cycle as well, I heard that from E, and just remembering that fundamentals are important and going back to the fundamentals. And the last thing that I wanted to pick up on what E said is around IPOs, because I believe in IPOs as well. And I don't just believe in IPOs for the startup ecosystem, but I believe that IPOs will build a better Nigeria. One of the things that I spent a lot of time arguing about when I was in school was the role of bank-centric economies versus stock market-centric economies. And because I like banks, obviously, I'm a bit obsessed with banks, I didn't want to accept the fact that stock market-centric economies are just more innovative